in this video, I'm going to give you a brief overview of some issues related to international taxation. So international tax is all about jurisdiction. Which country has the right to tax a company's income? So we can put this into two broad categories. We can think about outbound taxation and also inbound taxation. With outbound taxation, so I live in the U.S., so I'm thinking about U.S. as the host country. So when the U.S. government taxes foreign source income of a U.S. taxpayer. So let's take the company Apple. So Apple is a U.S. company, but they also do business in European countries like Spain and France. So if Apple were to generate revenue in France, is the U.S. government going to be able to tax that as income? And what are the rules for whether or not they can tax it? Inbound taxation has to do with whether the U.S. government can tax U.S. source income of foreign taxpayers. So just to give you an example there, let's take the company Toyota. So Toyota is a Japanese company, but they also sell vehicles, a lot of vehicles, in the United States. So what about the U.S. government's rights and ability to tax any income of Toyota? If Toyota is just selling cars in Japan, okay, it's a Japanese company selling cars in Japan. Obviously, any income from that is not going to be taxable by the U.S. government. But when Toyota is selling cars in the United States, now we say, okay, that is U.S. source income. So to what extent is U.S. government going to be able to tax that? So income is generally taxed where it is sourced. There are exceptions, and a lot of them, and we could talk about that in the videos to come. But just to give you a few ideas, so when we're thinking about personal service income, that's taxed where the services are performed. So if we're talking about like a law firm or something performing legal services, rent would be taxed where the property that's being rented is located. Royalties are generally taxed where the property is being used. Now, again, there are exceptions to all of these, and we'll talk about them in future videos. But I want to really focus on something here. Companies have a very strong incentive to shift income from high tax jurisdictions to low tax jurisdictions. Okay, again, I said international tax is all about jurisdiction. So if you are subject, for example, if your host country taxes corporations on 30% of their income, you would have an incentive to say, well, how much of that income could I shift to another country where maybe that other country only taxes 12% on corporate income? So you're saying, okay, well, how do I shift this income from the high tax jurisdiction to the low tax jurisdiction? You hear about like tax havens. Certain countries have lower taxes. For example, at the time I'm making this video, Ireland has a very low corporate tax rate, and they are known as a tax haven. So a lot of companies are trying to shift operations, intellectual property, and so forth to Ireland. So let's do an example. So let's say we've got a U.S. retailer. Okay, so U.S.-based corporation, they're a retailer. They've got retail locations and stores in the United States, and they generate $50 million in sales revenue from selling their products in U.S. stores, and they have $20 million in operating expenses related to their U.S. stores. Could be rent, wages, whatever. So you'd think, okay, well, $50 million minus $20 million of expenses, assuming all those expenses are deductible, you'd think it'd have $30 million of taxable income in the U.S. But let's just say that this company also had set up another company, okay, in Ireland to hold its intellectual property. And let's say that this other company, let's call it Parent. Okay, so Parent is in Ireland, and Parent is a holding company, and the U.S. retailer is a subsidiary of Parent. Okay, so basically these companies are related. Okay, so the Irish company, Parent, okay, so the parent charges $30 million to the U.S. subsidiary for the right to use the intellectual property. The intellectual property could be a lot of things, but let's just make this a really simple example. Let's think about the trademark. Okay, so the trademark of this U.S. retailer. Okay, they've got a trademark, maybe like a mascot, things like that. Okay, so they've got some intellectual property. They have transferred all the intellectual property. The U.S. retailer, their intellectual property, their brand is basically owned by this Irish company, and the Irish company is charging royalties. Okay, they're going to say, look, it's going to be $30 million for you to use the trademark and so forth. So now, if that's a deductible expense, and it's not straightforward that it will be, and we'll talk about that, but if it was a deductible expense, then it'd be $50 million of sales for the U.S. retailer, minus $20 million of operating expenses, minus the $30 million royalty expense. There would be zero taxable income in the U.S. for this U.S. retailer. Now, you say, well, this $30 million, though, is going to be taxable to parent in Ireland. Yes. Okay, and we will deal with that. Now, you say, well, could a transaction like this happen? Well, this is a really simple scenario. And I can give you examples of actual companies that have set things up like this in the past. But companies are really smart. They hire really talented attorneys, and they set up things a lot more complicated than this to try and basically shift taxable income to places like Ireland or other low tax jurisdictions. It's extremely common, okay, and United States Congress is aware of this, and so they've passed laws to try and reduce this type of behavior, this type of tax avoidance, okay? And so we've got some things that we're going to talk about in future videos. We'll talk about the BEAT provisions, base erosion anti-abuse tax, okay? It applies just to C corporations that have at least $500 million of gross receipts over the prior 3 years as of the time of this video, okay? So those are the rules for BEAT, which we will talk about. We'll also talk about Subpart F income, which applies to something called a CFC, a controlled foreign corporation. Controlled foreign corporation, long story short, if we just said that there is some company and it's in Ireland, but they're controlled by U.S. shareholders. They don't really have a lot of their own operations and so forth. And they're just set up to basically generate royalty income, or there's other types of income. I'll make a whole video on it. But in certain cases, it could be where whatever the profits are of that subsidiary or that company in Ireland, it could be deemed to be a constructive dividend. Even if they don't make a distribution to the company back in the U.S., it could be deemed a constructive dividend and be taxed. Okay, so we'll talk about this in more detail. And then also the Tax Cuts and Jobs Act in 2017 created this thing called GILTI. Okay, so when you think about GILTI income, global intangible low taxed income, okay? So that is not Subpart F income. That's something different. So basically, you've got these companies trying to structure transactions to say, okay, there's high tax in this country. How do we shift our income over to this other country where it's going to be a low tax jurisdiction? And so we can reduce our taxes. And then you've got U.S. Congress setting up these rules to try and prevent the companies from being able to engage in that kind of income shifting. And we'll talk about all this and a lot more in the videos to come.